You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, well, let's start by looking at the trade from last week. We looked at a strangle in two different pharmaceutical companies. We actually called it the doppelganger. And that trade in general didn't really work out. As a matter of fact, if we would have did it reverse, we probably would have been okay. So let me review what it was and we'll just move on because ideally you'd probably just close out the trade only because it has moved against you enough that you should probably just get out of it. But we were looking at Johnson & Johnson and Pfizer. And last week we taped the show on November 18th. The markets were closed. Pfizer was at 36.32. Johnson & Johnson was at 147.37. And we did say on the show that, as always, nothing's meant to be a recommendation. But overall, that this was a very speculative trade, and it was just a fun trade to look at. And I still think it will play out. I'm going to keep my notes here and actually look at it again before that expiration date. But we went out to December 18th, and we bought an out-of-the-money call on Johnson & Johnson. And we bought an out-of-the-money put on Pfizer. What has happened is Pfizer's gone nowhere. It's basically flat, and that put is down a little bit just because of time decay. And Johnson & Johnson has actually gone down. So Johnson & Johnson was at 147.37 on that day. And as of right now, as we're taping this, the markets are open today. It is the 25th. It is the day before we all eat turkey. And we see it at 143 approximately, but the market's moving. So that trade is down almost $1. We paid $3.20 for that, and it's currently trading for right around 150. So we've lost about 50% of the trade if you were to close it out right now. That is a number that you kind of look at on a lot of times when you're buying options outright, that if you lose half of your investment, you get out. You look to double on the upside. So I'd look to just close out the trade. Didn't expect Johnson & Johnson to actually come down this much. Looking really for the news for them to drive with their vaccine and a total speculative trade. Pfizer is, kind of crazy in that they were the ones that led the way on the 9th. They announced on that Monday that their phase 3 trials had a 90% positive rate as far as curing the actual vaccine, and all the test personnel from that 9th, and that drove the market higher and drove Pfizer higher. And the underlying stock now is all the way back to where it was. So interesting in that it had a huge run up of almost 20% in one day, and then it came all the way back. It ran up about 6 points on that day, and now it's kind of giving it all back. And a lot of it is that there are a couple other pharmaceutical companies that have came out with similar type success ratios, and their vaccine does not need to be refrigerated, where Pfizer's does. And so I still don't, it's still a vaccine, but the stock has been beaten up a little bit. Hopefully with Johnson & Johnson's, their vaccine won't need to be refrigerated either overall. So we'll keep this in our back pocket, but we're going to move on to today's trade. We're getting into the end of the year, and I just want to talk a little bit about trying to get to the other side of this pandemic. We're still not there. We got some good news, obviously, from the pharmaceutical companies, but our economy is still taking a beating, and we do not have any stimulus in sight, at least in the near term. Over the next couple of weeks, it's anticipated that we don't really see any stimulus that's coming into the marketplace, but the markets have rocked. The Dow did pass 30,000. So your Dow 30,000 hat that you bought or online should have paid up. You had one day that you could wear it. The Dow is back down below 30,000 right now, but it did breach that level, which is amazing for the markets. VIX is still trading above 20% implied volatility. So even though we're setting new highs in the Dow, we got the volatility still up, just showing the nervousness of the marketplace. But another good little tidbit that we should mention is that the Russell 2000 keeps hitting new highs, and they set a new high this week, which means it's kind of leading the markets higher. And that's very good when you see overall the small caps leading the markets higher. So a little bit of mixed metaphors as usual at the marketplace. The biggest one is probably the fact that the VIX just will not breach that 20 level, and it hasn't since the downturn in March. Okay, so fear of missing out trade. So there are some industries that haven't got back to the highs before the March downturn. And in general, one of them I kind of like to look at is the actual financials. The financials weren't necessarily hurt by the COVID, but the announcement, just in general, people are still banking and they're still using their services overall. But the yields have been low. The yield curve has not been favorable for the banks, and they've not really bounced back. So if you're looking for these sectors, we already talked about, actually prior to the election, we kind of mentioned this, JETS and the airline industry. JETS is the ETF that tracks the airlines. And you could also look at travel stocks, the cruise lines. Those companies have definitely not made their way back, and rightfully so. So how might I participate in these underlying industries that haven't made their way back to where we were before the March turndown? And the one that I think is a little less speculative is the XLF. And if I actually look at a chart on the XLF, recently it made a decent move if you just kind of look at the Fibonacci levels. The XLF right now, as I mentioned, it is the 25th and the markets are open. We got it trading at, we're going to round it off to 28.51. But over the last 4 or 5 trading sessions, we saw the XLF actually break out above the 61.8 Fibonacci retracement level that goes from the downturn in March to where we're at right now. So we broke through that level. The 100% retracement would mean we'd get back to around 39.50 approximately. That would be where where we were before the big downturn in March. So that means, in general, the path of least resistance could be to the upside. The fact that we did break through that number, there's no real overhead until you get back to the 100% retracement level. So let's buy a long-term option contract. And as always, it's not meant to be a recommendation here on Options Playbook Radio, but I'd like to think of, on a lot of these ETFs that are fairly liquid, JETS, XLF, XLE in the energy space. If there's a sector that you're interested in, but you're a little bit nervous about the marketplace, if you have liquid underlying stocks, it makes sense to me to rent the stock as opposed to buy the stock outright. XLF is a $28 stock. So it is feasible. It costs you $2,850 approximately to buy 100 shares of stock. But if I go out until June, give us a good bit of time going into the next year, I'm just going to look at buying a surrogate for owning that stock. So what I want to do is buy an 80 delta or higher option contract. And if we wanted to, we could actually sell some premium against it, some short-term option contracts, just like you might do in a covered call situation. And that strategy inside the options playbook, we call a fig leaf. And we haven't mentioned that in quite a while. We actually named that strategy in the options playbook because I basically thought it needed a name because a lot of people like to do this strategy. The only concern about doing a trade like this is that as you go further out in time, and you look at the longer term leap options, in particular on less liquid underlyings, you usually get very wide bid-ask spreads comparative to buying the stock outright. And that is always a concern when you're trading options in general, but it really becomes apparent when you get longer term and go deeper in the money. So we're going to go to the June 18th expiration. This is going to officially be our paper trade. And I want you to think about other sectors that you might do this in, because all we're really trying to do here in Options Playbook Radio is just learn about, in these type of market conditions, what type of strategies might work for you. We did have the volatility come down. We see actually this June contract, the at-the-money implied volatility is right around 22% going out 205 days. So it's not low, but it's not high. It's came down a little, quite a bit since the downturn in March. But recently, the volatility has dropped off in the XLF. And so we're going to be looking at buying that volatility, the 25 strike. And that currently is trading for a 79 delta. And the bid ask with the markets open and rocking right now is 420 by 435. There's a decent amount of open interest. There's a little bit of volume today. Might want to work it, try to get 425, but a 10-cent wide bid-ask spread on a longer-term option contract isn't that bad overall. It's not great. It's not as good as the stock, but trust me, in the options trading world, that's not a bad bid-ask spread on an 80 delta option contract. So the reason why I bring this up is, well, if you're kind of nervous about the marketplace, a lot of people don't think about this and that. Well, I was going to buy the underlying stock. I'd like to buy the underlying stock, but I'm a little bit worried about the economy. I'm a little bit worried about the fact the VIX just won't come below 20 at this point in time. How can I participate on some upside on some of these industries that have been beaten up and not risk, have all the risk of just owning the stock outright? So if we paid about $425 for that option contract, we'd only be putting up about 14% of the actual stock price. So right there, we know we can only lose $425, and that's it. $425 plus commission, that would be our total risk. Now, you might say, well, 14% is still a good chunk of change, right? Well, and that's true. But here's another advantage of buying a leap option contract. If I put this trade on, we are $3.50 in the money. And I say to myself, well, if it comes down to 25, I'm going to want to get out of this position. In other words, I'm going to sell the underlying stock or this option contract when it comes down to 25. That's a good thing in the options world in that that's where all the time premium sits. So it also gives you kind of a small pillow to land on. It gives you a little bit of protection because on the upside, if the stock continues on up, you gain delta. The delta is going to slowly creep towards 1, which means it's going to act a lot like the stock. But if the underlying goes down, you actually lose some delta. And if it's right at the money, that's where you get this increase in time value overall, and it can help protect you on the downside. So you just have to you got to have that type of mindset that, okay, I'm going to put this trade on. If it goes up, that's great. My total risk on this trade is going to be 14% loss in this underlying stock if it went down, or $4.25 compared to buying the stock outright. But if it goes down to 25 or gets in that range, I'm going to sell and I'm going to capture what's left. But if it continues on up, I still get a lot of bang for my buck because I bought this expensive option contract, or basically this option contract that acts a lot like the stock. Now, the fig leaf portion of this would mean that I would want to sell some short-term premium on this. So if I go back and I look and I say, okay, if I buy this option contract, I'm still paying time premium. If I look at the time value of this 25 strike call, it's approximately, it's around 96 cents or so, but we're going to round it to $1. Let's call it $1. So I'm paying a buck of time premium out of my $4.25. I would like to whittle that away if I could. So how could I do that? I could try to generate some capital by selling calls against this long-term leap option. Now, as I mentioned, the vols have came down. We're trading at about a 22% vol in that June expiration. I would want to do something as short-term as possible, because if I'm selling this call, I do not want this underlying stock to get called away. So I looked at the calls before we started our conversation today, and it just really isn't a lot of juice in them. But I would be more apt to do this on the leap option than on the stock, in that if I go out to the December 18th expiration, it's 23 days away, and I sell something that's a point away. Stocks right now is at 28.50. I sell the 29.50 strike. I can bring in about 30 cents on that. And 30 cents, if I'm doing a covered call on my 100 shares of stock, well, that's not even a real good dividend overall, but it is over a shorter time frame, 23 days, that I would get that. So annualize it wouldn't be a bad return. But that $30, it doesn't really chip away at my total stock price, but on my option contract it does, right? We're bringing in 30 cents. When you think about that, I have a $1 worth of time premium. If I could sell 4 30-cent option contracts, I could take that time premium out of the picture. So at times, I might think about selling the call against it, going on out to the June. I would obviously try to avoid the earnings period on all the financial stocks in general. But this is the one way that you can approach this. I'm buying this. I'm worried about missing out. I got capital I haven't allocated because I'm worried about the downside risk. How can I allocate that capital without all the risk of actually buying the stock outright? And so if you have sectors that have liquid exchange traded funds, this is one way that you could take that approach, put the capital in, not risk all of that capital, but you're still participating if those sectors will come back to where they were before the big March turndown. Well, if you're listening to this, you might be around the dinner table eating some turkey. So I want to wish everybody a happy Thanksgiving. So that's going to be it for this episode of Options Playbook Radio. If you have any topics you'd like to discuss on the show, or a question you'd like me to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Please follow me on Twitter. My handle's @BrianOverby. Doesn't get any easier than that. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.